If your financial planner or your favorite TikTok guru told you that a 5% high-yield savings account is the best passive income strategy right now, they are giving you incomplete and, frankly, dangerous advice. Because I'm here to tell you something they won't. If you live in a high-tax state like California, New York, or Massachusetts, your 5% HYSA is secretly only paying you about 3.5% after state taxes. You are actually losing 1.5% of potential yield without even realizing it. We need to talk about the hidden cost of convenience and why the safest place to keep your cash is actually costing you thousands. This isn't about chasing the highest APY number. This is about optimizing your net yield, what you actually keep in your pocket. In the next 15 minutes, I am going to expose why the most tax-savvy investors are ditching the conventional HYSA wisdom and quietly moving their emergency funds and large cash reserves into a powerful, virtually risk-free alternative, the US Treasury Bill, or T-bill. By the end of this deep dive, you will know exactly how much state tax you are truly forfeiting by using a HYSA. The one massive tax loophole T-bills offer that HYSA can never match. The precise strategy to split your cash between T-bills and HYSA to maximize both safety and after-tax returns. If you're ready to start playing defense with your money like the ultra-wealthy and legally minimize your state tax bill, you're in the right place. I'm host named Mindset from Mindset for Wealth, the channel dedicated to giving you the unvarnished truth and the deep dive analysis required to build real wealth and financial discipline. We cut through the noise so you can make informed, expert-level decisions. Before we expose the HYSA illusion, do me a favor. If you value expert financial analysis over financial fluff, hit that like button and subscribe to Mindset for Wealth. Turn on notifications so you don't miss the next strategy that can put thousands back in your pocket. Let's dive into Tax Shelter Showdown.
Welcome to Mindset for Wealth, where money meets mindset.
The high-yield savings account, or HYSA, has dominated the cash holding conversation for the last 3 years. And to be fair, they were a massive upgrade. For decades, traditional banks were offering a paltry 0.01% APY, forcing investors to either accept losing money to inflation or take unnecessary risks. When online banks started offering 4%, 5%, and sometimes even 5.5% APY, it felt like a financial salvation. We all collectively cheered for the safe 5% return. But that collective cheer ignored a fundamental principle of investing. It's not about what you make, it's about what you keep. Here's the illusion we need to expose. A high-yield savings account is just a regular savings account with a better rate. And because it's a regular bank account, the interest you earn is treated as ordinary income by the IRS and critically by your state tax authority. Think of it this way. When you deposit $100,000 into an HYSA earning 5% APY, you are earning $5,000 in interest annually. That $5,000 is fully taxable at both the federal and state level. While federal taxes are a given for nearly all income streams, the state tax is the silent killer of your yield. Let's run the real numbers, the ones your bank doesn't show you. Imagine you are a high-earning professional living in California, New York, or Oregon, states with some of the highest marginal tax rates. In California, your top marginal income tax rate can reach 9.3%, or even higher for very high earners. If you are earning 5% on your $100,000, that $5,000 interest payment incurs a $465 state tax liability, assuming the 9.3% rate. Your 5% nominal yield just became a 4.535% actual yield after state tax. Now let's consider New York. New York State and New York City combined can easily hit a combined marginal tax rate of over 10%. That $5,000 in interest now means over $500 goes directly to Albany and City Hall. Your 5% nominal yield just became a 4.5% actual yield after state tax. This reduction is significant because it erodes the high yield advantage, especially when compared to inflation, which might be hovering around 3% or 4%. You are paying a high price for the convenience and accessibility of your HYSA. And for large cash balances, say $500,000 or $1 million, the state tax liability alone becomes a 5-figure drain on your passive income. The key takeaway here is this: your HYSA is not a passive income strategy. It is a passive income liability. It's highly convenient, perfectly safe, up to the FDIC limit, but it is financially inefficient because it fails the tax optimization test. The question then becomes, how do the wealthy, the tax strategists, and the most conservative capital allocators handle their cash reserves? They don't just chase the highest advertised number. They look for the tool that offers the highest after-tax risk-free return. And that tool is not the HYSA. It's the US Treasury Bill. We've established that the high-yield savings account is bleeding your passive income through state and local taxes. Now let's introduce the counter strategy, the US Treasury Bill, or T-bill. This is the cornerstone of cash management for institutions, major corporations, and the tax-savvy ultra-wealthy. What exactly is a T-bill? Simply put, it is a short-term debt obligation backed by the full faith and credit of the United States government. When you buy a T-bill, you are essentially lending money directly to the federal government for a short, defined period, usually 4, 8, 13, 17, 26, or 52 weeks. There are two critical reasons why the T-bill immediately defeats the HYSA in a high-tax environment. Reason 1, the apex of safety. Unlike the HYSA, which is insured by the FDIC up to $250,000 per depositor, the T-bill has no limit on its safety guarantee. It is backed by the entire taxing and borrowing power of the US government. For those with substantial cash reserves well over the FDIC limit, the T-bill is the only true home for their money that is genuinely zero risk. This is not just a matter of safety, it's a matter of financial peace of mind. Reason 2, the tax shelter loophole, our core focus. This is the game changer, the hidden clause that transforms your yield. The interest earned on US Treasury securities is exempt from state and local income tax. Let that sink in. While your HYSA interest is fully exposed to state taxation, T-bill income is not. This single loophole creates an immediate, guaranteed yield advantage over every single high-yield savings account in high-tax states. Let's revisit our California example. We saw that a 5% HYSA yield dropped to about 4.535% after the state tax hit. Now imagine you purchase a 5% T-bill. Because that 5% is entirely free from state tax, your actual yield remains 5% minus federal tax, of course. The difference in the after-tax risk-free return is substantial. You just gain back that 465% of lost yield instantly. On $500,000 in cash reserves, that difference is $2,325 per year, purely saved from state taxes. That's not a return, that's a guaranteed tax cut. How to execute: accessing T-bills. Many mistakenly believe T-bills are complicated or only available to large institutions. That is false. You have two easy routes to acquisition. Treasury Direct, the direct government portal. This is the most straightforward way and ensures you get the full tax benefit without complexity. Brokerage accounts. Major brokerage firms like Schwab, Fidelity, or Vanguard allow you to purchase T-bills just like stocks or ETFs. Be aware that some brokerage statements may require careful reporting to claim the state tax exemption, but the exemption itself still applies. The T-bill is not just an alternative to the HYSA, it's an evolution. It offers superior safety and, critically, a profound immediate tax advantage for every American living in a state that levies income tax. If you prioritize net profit over nominal numbers, the T-bill must become the new home for your large cash balances. We have laid the groundwork. We know that the high-yield savings account is convenient, but it subjects your interest earnings to state tax. We know that the US Treasury Bill offers near-perfect safety and, crucially, a guaranteed exemption from state and local taxes. Now, it is time to run the real math. We are moving past the glossy advertised APY and focusing exclusively on the real after-tax yield, the only number that genuinely matters to your personal finance. To demonstrate the power of the T-bill tax shelter, we will analyze the returns for a hypothetical investor, Jane, who has $100,000 in cash. We will assume a consistent 5.25% yield for both the HYSA and the T-bill and a 24% federal tax bracket. We will compare three critical scenarios based on Jane's state of residence. Note, calculations assume the state tax is deductible, but for simplification and worst-case scenario analysis, we focus on the rate difference. The actual calculation for the table is based on the remaining yield after tax is subtracted from the nominal yield. T-bill yield equals 5.25% times 1 minus 0.24 equals 3.99%. NJ HYSA yield equals 5.25%, 1 minus 0.241 as 0.037 is 3.65. CA HYSA yield 5.25% times 1 goes 0.23 equals 0.5%. The results are stunningly clear, and they solidify our contrarian viewpoint. The HYSA is only the best choice if you live in a state with no income tax. For Jane in Texas, the choice doesn't matter from a tax perspective. The after-tax yield is identical. But for Jane in New Jersey, the T-bill delivers a guaranteed 34 basis points BP of higher return. On $100,000, that's $340 more in her pocket every year, simply by choosing the right asset. Now look at Jane in California. With a nearly 10% state tax rate, the HYSA yield is decimated. The T-bill is giving Jane a massive 49 basis point advantage. That's nearly 0.5% better return, risk-free, and legally shielded from her state government. This is the power of the tax shelter showdown. When a high-yield account advertises 5.25%, they are showing you a return that is fundamentally flawed for millions of Americans. The T-bill, offering the same nominal yield, automatically becomes the superior passive income vehicle simply because of an archaic but powerful tax code rule. Beyond the percentage, the absolute safety factor. Let's quickly address the safety aspect, especially crucial for our Mindset for Wealth audience who hold large cash reserves. While the FDIC limit of $250,000 provides comfort, it requires spreading large sums across multiple accounts, leading to administrative headaches. The T-bill bypasses this entirely. Whether you have $100,000, $1 million, or $10 million, placing it in a T-bill means you are fully backed by the United States government. This is the institutional grade safety standard. If the US government defaults, your HYSA will be the least of your concerns. This makes the T-bill the superior choice for high net worth individuals and disciplined investors seeking absolute preservation of capital alongside tax optimization. This is the core of the contrarian expert strategy. Don't settle for good enough when managing your cash. The difference between a 3.5% and a 3.99% net yield might seem small, but over decades and with compounding interest, that 0.5% difference equates to tens of thousands of dollars in lost opportunity. You must make the tax code work for you, not against you. We've proven that T-bills are the financially superior vehicle for your cash reserves in high-tax states. But this doesn't mean you should empty your HYSA tomorrow. The optimal cash strategy is not all or nothing. It's about strategic allocation and liquidity management. Here is the Mindset for Wealth blueprint for managing your cash reserves in the high-rate, high-tax environment. Step 1. The cash split strategy. You need to tier your emergency fund and cash reserves based on liquidity needs. Tier 1, ultra-liquid cash, 30% of emergency fund. This money is for true, immediate emergencies. A tow truck, a quick flight, an unexpected repair. And this should remain in your high-yield savings account. Why? Because wire transfers and debit card access from a standard HYSA are instantaneous. The convenience here outweighs the minor tax hit, as this is a relatively small portion of your total cash. Tier 2, tax-optimized reserves, 70% of emergency fund and all other large cash balances. This money is for larger, predictable expenses or long-term safety. Job loss, a large medical deductible, or a down payment you plan to make in 6 to 12 months. This money should be parked in T-bills. You can't afford the 4-week to 13-week delay in access because these are not instantaneous emergency needs. This is where the tax shelter shines brightest. Step 2, implementing the T-bill ladder. The primary drawback of a T-bill is its fixed maturity date. If you buy a 13-week T-bill, your money is technically locked up for 13 weeks. The solution and the gold standard for liquidity management is called laddering. A T-bill ladder ensures that a portion of your cash becomes liquid every few weeks and giving you the necessary access without sacrificing the tax-free yield. How to build a 4-week T-bill ladder. Week 1, today, purchase 25% of your Tier 2 cash in a 17-week T-bill. Week 4, purchase the next 25% in a new 13-week T-bill. Week 8, purchase the next 25% in a new 9-week T-bill. Week 12, purchase the final 25% in a new 5-week T-bill. After 17 weeks, your first T-bill matures. Then, every 4 weeks thereafter, a portion of your T-bill holdings will mature and be returned to your Treasury Direct or brokerage account. At maturity, you can decide to redeem the cash, or more commonly, roll it over into a new 17-week T-bill. This creates a rotating, always maturing, tax-advantaged stream of cash flow, the ultimate passive income strategy for your cash. This strategy transforms a fixed-term asset, T-bill, into a highly liquid, tax-efficient, and risk-free passive income stream. The key is execution. Open your Treasury Direct account today, determine your Tier 2 balance, and start building that ladder immediately to capitalize on today's high rates before the Federal Reserve potentially cuts them. So here's the Mindset for Wealth takeaway. The conventional wisdom that the high-yield savings account is the ultimate safe harbor for cash is officially obsolete in a high-tax state. It's an illusion of safety and yield that costs you thousands annually in state taxes. Our contrarian position is clear. For large cash reserves and your core emergency fund, the U.S. Treasury Bill is the superior passive income tool. It offers absolute unlimited safety and, most importantly, provides an immediate guaranteed tax shelter against state and local income taxes. You must prioritize the net yield you keep, not the gross APY you see advertised. Financial discipline isn't just about what you invest in the stock market. It's about how strategically you manage the cash you aren't investing. Make the tax code work for you, not against you. If this deep dive into tax-optimized cash strategy has given you the confidence to execute this superior plan, please let me know in the comments below. Are you opening a Treasury Direct account today? And if you want more expert-level financial analysis that cuts through the noise and helps you build wealth with discipline, be sure to subscribe to Mindset for Wealth. Hit the notification bell so you don't miss our next critical strategy. Start building your T-bill ladder today. Thank you for watching, and I'll see you in the next analysis.